Welcome to the Ask Philip podcast. Today, Philip answers the question, the market is in free fall. What should I do? Philip Washington Jr. is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance. And now, here's Philip.
All right. As we speak, the crypto markets are in free fall. It's getting pretty nuts out there. It's actually a interesting and exciting time for those of us who've seen a couple of crypto markets. And really, if you've just been an investor in general, and you understand how markets work and how psychology works. And so this is an interesting time because this is where all the opportunity comes. And so what I did today was I'm pulling it up right now. I created this this hypothetical analysis of different very volatile stocks, because when you invest, the key in investing or your return over time is heavily correlated to how much volatility you can withstand. Or said a different way, if you're an employee of a company and you're an employee of a quote unquote stable company, so think like government job is the most stable job. The trade-off is you're just not going to make that much money long term, right? You're not going to have too many government employees making $400,000, $500,000, $1 million a year. But then you look the other way and then you say, okay, let's look at an employee who works at a startup, making a little bit of money, but over time, if they're successful, their compensation is crazy because they're in an industry that's taking market share if they're successful. So they've taken it, their salaries goes up. Plus, a lot of them get a lot of stock options and compensation in those early companies, and they end up, becoming crazily rich. Like a lot of the big time VC angel investors of today were early employees at some of these early tech startups. So investments are the same way. It's just life, right? You get rewarded financially according to your level of faith. There are no shortcuts. There's no way to earn higher returns without embracing the volatility. And it doesn't mean you have to embrace the volatility, right? If you're fine with lower returns for security, for just mental health, that's cool. But you're going to have to deal with some level of volatility, because what's known and certain, like what we know, and this is just from Fed policy, government policy, understanding economics, is keeping your money in cash and bonds over the next 10 years is going to be a terrible idea, likely, because the federal government has said, in order to achieve our financial goals, we're going to have an inflation target. And what does an inflation target mean? Well, we've talked before about inflation being the government making the value of your money worth less. And so if you look at current expectations of governments around the world having to print money at a 10 to 15% a year rate, that basically means let's use 10%. At 10%, that means that the value of your money gets chopped in half in 7 years. So the value of cash gets chopped in half in 7 years if the government's making it worth less. And as I mentioned on the episode yesterday, in order for the government to pay off all this debt, they have to either default or create all this, fake funny money. And so there's no other way around it. And so we know that cash, which is historically considered quote unquote safe, we know that's just about as close to, we know there's there's a almost 0% chance that you're not going to lose purchasing power in cash. By the way, like if you look back over 10, 20, 30 years, like 100% of the time, your cash has lost value because they've made the value worth less. Like we grew up in a world where inflation is normal, and we're used to them making the value of our cash worth less. And so what you want to think about is, all right, and that's the least volatile, but that's not the safest. So what level of volatility do I want to take on in order to make sure that that I maintain wealth? And so if you go back to my previous example of the government printing money at 10 to 15% a year, like to maintain your wealth, you at least have to keep pace with the money printing rate, which means you at least have to have a 10 to 15% return over time, if that's the printing rate, over the next 5-10 years. And so that pushes you out in asset classes that earn 10 to 15%, a year. And so those are typically volatile. And so, the sucky part of the environment that we're in right now is that, 30 years ago, if people did not want to deal with volatility, they didn't have to. They can just buy bonds, and their returns on bonds, above the money printing rate and inflation rate was sufficient. Today, it's not happening because we're transitioning from one financial system to another, and there's just lots of volatility every time. I use the example again of, you being a UK citizen in the 1940 and deciding to move your assets to the United States economic system at that period of time. It seemed risky because America was more volatile than Britain. Britain had been stability for the world for the last 100 years. But fast forward, British wealth relative to American wealth over that last 80-year period of time, it's not even close. Like American wealth is significantly higher than British wealth. And so going back to what I've done, I said, hey, listen, I know folks are going to be panicking. I know by the time I get this podcast out, get lots of emails and phone calls on the market and what's going on. And so I said, okay, let's look at the most volatile stocks, but that were like known disruptors. And let's look at their 3-year three-year rolling returns, for those investments. And what is 3-year rolling returns? Basically, it just says, hey, you go back to a period of time, right? And I believe we go back to 2015, really beginning 2016 on this deal. And I say, hey, on a 3-year period of time, so every 3 years, right? So January 1st, 2016 to January 1st, 2019, it's like one rolling period of time. So they do that every month, right? A rolling 3-year period every month. And basically it just says, okay, over those periods of time, what was the highest returns? What was the lowest returns over the 3-year period of time? And so again, I went back to some volatile stocks, but that were known leaders. And that's important because if one of my fundamental investment philosophies is the core of your portfolio should be in a well-diversified portfolio. But if you go into something that's, not as diversified, don't guess, bet on the clear winner, right? So find the investment opportunity that is the dominant leader in a specific market. It's, 100 times better than the next closest competitor, and it has significant upside, right? I like to say 100 times upside from where it is right now, but realistically, at least 10 times upside from where it is right now. And so, but in a disruptive area, like 100 times from where it is right now is not significant, right? It may not happen in 5 years or 10 years. But I'm just saying it needs to have a lot of upside. And so you think about that, those companies are companies clear winner. And these are companies on the list. So one company I look at is Alphabet over that period of time, right? Definitely looking at 2016, definitely 5 years ago, we all knew Google was like the dominant leader. Like it wasn't a question. They've been leading for a while, but they're a dominant leader. So I put them to the list because at that time we could have said, hey, they're a dominant leader, but they're very volatile of an asset class. And so, or of a stock. But over that 3-year period, if you invested in Google, the time period that the average return over that time period, the average return, from basically end of 2015 to current, and we end the study at the end of April. But over the time period, the average return was about 23% a year over that period of time. Now, the highest three-year rolling return over that period of time was 32% a year. The lowest rolling 3-year return over that period of time was 10%. It was from 12/31/2015 to 12/31/2018. And I'm using Vanguard Morningstar report to put this together. So now let's look at Amazon, right? Amazon, again, 6 years ago, clear winner. We know. So we were not guessing. Very volatile stock though. And so over that period of time, 11/30/2015 to 4/30/2021, the annual return of Amazon was 35% a year, 35.65 to be exact. The highest 3-year rolling return was 52% a year, and the lowest 3-year rolling return was 26% a year, or 26.93. Let's look at Apple. Apple average return over the period of time, about 33% a year. The highest 3-year rolling return was about 48.89% a year, and the lowest 3-year rolling return was 16.44% a year. We go to Facebook. Facebook period. These are all the same periods, y'all. Just so you know, for the average over the period 11/30 to 4/30, 23.36%, 23.36% a year. The highest historical return 3-year period over a 3-year period of time during that time period was 23.64, and the lowest return over that time period, lowest 3-year rolling return, is 5.5%. Go to Grayscale Bitcoin Trust, which is, what we use for our for the clients that have a Bitcoin position in the portfolios we use. The average return over that period of time for GBTC was 131.69% return over that period of time. The highest 3-year rolling return was 135%, and the lowest 3-year rolling return was 7% a year. Square average return 74.39% a year. Highest rolling 3-year return 101% a year. Lowest 3-year rolling return 44.72% a year. And Tesla really was the only one that you'll see. So the average return was 65.68%. The highest 3-year rolling return was 132.38%, and the lowest 3-year rolling return was negative 6.04%. So Tesla was the only one that had a rolling 3-year negative return. I actually expected to see more over a 3-year period of time, which is fine. But my point in illustrating this is if you have a portfolio that's less diversified, betting on innovation, disruption, is basically if you're saying, hey, here's the vision of the world 5 years from now, 3 years from now, 10 years from now, right? And you're saying, I think these companies are best positioned for where the world is moving. So I'm going to own them. The thing is, when you do that, when you're owning transition type innovative companies, between now and then, there's a lot of volatility. And just imagine, markets are run by humans. Humans do not do well with change. Think about when you've had to go through rapid change in your life. There was lots of volatility. On the other end of it, it was better. On the other end of it, things worked out better. And so you were happier. But during the transition, it was messy. It was volatile. And so, and it was hard to have faith in the future. It was tough to stay disciplined. It was tough to stay patient. But if you did do those things, then you realize the better outcome in your life. And the same is true in investing, right? And again, this is assuming you're right. Right? If you pick the wrong stocks, maybe not so much. But this is why I say and this is what I do when I'm building a portfolio. I don't like to guess on the stocks and the individual positions that I own. I like to say, all right, what are the clear winners? They have a good track history. They're way better than the next competitor in that space. And then let's own them, right? And then net, if we have a portfolio of those type of ideas, even if a few are, negative over, the investing time frame that we have, which is 5 years, the other ones that are positive, pay off. And so that's why in these type of scenarios, like what's going on for the last few weeks, and specifically today, I actually get a little bit excited. I text a client of mine who's also like a really good friend. I said, hey man, I just paid taxes. I'm so upset. I should have did an installment loan, right? And then I'd have been able to buy the heck out of these dips because, I bill quarterly, and so I won't get my next chunk of change until July. And so, I'm like, man, I'm out of cash. But it is what it is, right? A lot, some folks are on the freak out side, but the folks that get it and that understand and that embrace volatility, like we're all anxious for a different reason. I'm like, I need some more cash. I want to buy this stuff. I've been waiting for these prices, to be here. So It's okay to have the fear, to feel the fear, acknowledge it, right? If you have a wealth manager advisor, call them. If you're super anxious, like the best way to do is talk about it, which is why I'm doing this episode. So listen to positive stuff. Go to your, if you got text group or chat groups of investors, use them for assurances, but don't make an emotional decision, right? If you did the work and you built the portfolio appropriately and you feel like, you're right position, stick with your plan. Don't abandon the game plan, but you just better hope you did the work right. So y'all enjoy your day. We'll talk tomorrow.
If you are interested in having a review of your portfolio or to see how far on track you are with your retirement goals, Philip offers complimentary consults through his company, Stonehill Wealth Management. For more information, log on to stonehillwealthmanagement.com/talk. That's stonehillwealthmanagement.com/talk. Philip Washington Jr. is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.